Welcome to Copytraders Club, where you can learn how to make more money copy trading. I am Gavin McCauley, my name and username on eToro. Today is a very entertaining chat with a PI. eToro is full of young, new investors learning their trade, but there are those who have been there and done it over decades and bring all that experience to the table. We talk growing as an investor, retiring at 42, dancing chickens and vomiting camels, and more. Here we go. Episode 12, and we are joined at the Copytraders Clubhouse today by a man who is something of an elder statesman among PIs. While some PIs appear to be barely out of nappies, he is living the pampered lifestyle of an early retiree, something many copy traders dream of. But let's put our dreams aside and focus on the very real sight of the limousine pulling up, and as the white-gloved driver hastens to open the door, we catch our first glimpse of the silver fox himself. And here he comes. Mik, welcome to Copy Traders Club.
Thank you, Gavin. Good evening.
It is indeed a good evening to have you here at the clubhouse. Before we go through to the lounge, we've got to get you signed in via these quickfire questions. Are you ready for those?
I am.
Username on eToro.
Lojikfool.
Date you joined eToro.
Boxing Day 2019.
Year of birth.
1970.
Place of residence.
Singapore.
Profession.
Retired hospitality marketing revenue management.
Briefly state what you aim to achieve on eToro.
Fame, money, helping others.
Name one of your investing heroes.
David Gardner from the Lojikfool.
Name one of your favorite investing books.
Probably going to stick with the Lojikfool again. They have an investment guide, which is probably a good place for anyone to start.
That completes the formalities. To the Copy Traders Lounge now. Alan Michael Mullins, aka Lojikfool, are you ready for this magical transition?
Yes, thanks.
So here we are now in the Copy Traders Lounge. Alan Michael Mullins from England, but you prefer to go by Mik Mullins.
Yes, an old nickname I took or was given to me a long time ago.
So you are English, but with a name like Mik Mullins. I'm assuming that comes with a large green asterisk.
It does. My father's Irish. I do have an Irish passport, but I had my English passport before I had my Irish passport.
On the subject of names, where does the name Lojikfool come from?
I was given a nickname of Jester about age 16 because I guess I goofed around a lot. And from there came the Fool, which linked with the Lojikfool, I guess, as I had an account there. That was sort of, I've been using that as a username. And then a buddy of mine just started adding the suffix logic to a few nicknames. And so just mashed it all together and became Lojikfool.
It's always interesting to ask people on eToro where they come up with their names from.
Sure.
For most of them, I think it's their gamer name.
Well, you'd be surprised how many PIs are gamers. I believe Jay is a gamer. I am an ex-gamer, and I see a lot of parallels between being good at winning the game of investing and winning certain computer games. Yeah.
Okay, so let me try and tell your story in a nutshell, and then we'll build it out, right? So here you are, a young guy in England. You get introduced to investing at a young age. You dollar cost average in with regular deposits, monthly deposits, year upon year upon year, make a stack of cash investing while working regular jobs, and then retire at 42 and now you live the good life in the tropics and you do whatever you want. Is that about right?
It's not too far off, Gav. Yeah.
Okay, well, let's start at the beginning then. You start investing at an early age. Tell us about that.
Well, I think the very first one was age 16. I think my grandma left me £100. So probably that doesn't really count. But I wanted to buy shares in Harry Ramsden's Fish and Chips to get the discount on buying fish and chips. And then I started to do my own thing at college. I worked at a Mexican restaurant. I spent half the money on beer, and the other half, I started to buy stocks and shares. Started there, and then on and off, and nothing seriously. I watched the great tech bubble of the end of the millennia come, and I missed the boat. So I just watched from afar, and then the crash started happening, and I thought, ooh, now's the time to start dollar cost averaging in. So it was about 20 years ago that I really started the dollar cost averaging in, and I made almost every mistake in the book, and I really, my whole strategy has evolved. Basically, it's literally the process of evolution where I keep doing what works and I stop doing what doesn't work, and eventually I've ended up where I am. I still make mistakes. You'll hear from me the hardest mistake is emotional control. Over trading, taking profits too early. There's another angle on that, which I call insurance, which we might be able to get into later as well. And then maybe about 10 years ago, I started mentoring some close buddies and some not so close buddies. And I really enjoyed helping people. And everyone from a friend who couldn't afford an apartment to 7 years later being able to afford an apartment, to a buddy who had cancer calling me in to have a meeting with him and his wife, who became his widow. And he said, I need you to try and make sure she doesn't have to work again. And she hasn't had to work again. So, and also had 15 taxis outside my door one day because a taxi driver had overheard what I did, and he was starting an investment club, and he wanted me to, present to all his members, what I've been up to. And so from that evolved my investor education presentation, how to mentor and guide and teach others.
You retired at 42 from a profession as a hotel marketing consultant or something similar?
Yeah, that's right.
So you're, in effect, the end result of what many eToro users are seeking to achieve.
Yeah, I'd like to think that if you dollar cost average for 20 years, I think around the numbers for every $1,000 a quarter, and obviously not everyone can afford $1,000 a quarter, but for every $1,000 a quarter, if you can make 15%, which again is a big ask, but I've made 17% for 18 years. Every $1,000 a quarter would be, I think, $500,000 in today's money after 20 years. So, it starts to be, financial independence or retirement on time starts to be a little bit more attainable if you start early and you do the right things.
And you mentioned the emotions earlier on, handling your emotions. I came across it somewhere where it said that you don't look at your portfolio any more than once a week. Is that the case?
I advise that. But I try not to look at it too much. And best practice would be, there's some studies done with some college students on model mock portfolios. And the guys who looked at their portfolio every 5 years instead of every month in the model mocks scenario perform the best.
Yeah, or people who died and it never became knowledge that they died, went on to make ridiculous sums.
I heard about that one as well. Yeah.
But I guess there's a difference here when we're talking about copy trading and investing, insofar as it strikes me that you're a long-term investor. However, copy trading and eToro seems to have a much shorter time horizon. It's kind of intermediate term investing. People are expecting things within 6 months, 2 years, as opposed to a buy and hold and forget about it for 10 years sort of thing.
I think that's a matter of education. I would like to think that as people get more experience, what I tell people is, take 5% of your portfolio, or take your pocket money, take your entertainment money, and go play with it. But if you want to make serious money, according to theory and experience, my portfolio mechanics are optimal, basically. And then that is mostly buy and hold. And whenever I haven't bought and hold, I've made less money than I would have otherwise.
Now I'm going to ask you a random question from the book, The Art of People. So can I ask you to pick a number between 1 and 10?
6.
What's one thing you would like to be doing or to have 5 years from now?
I had a mini health scare, which looks like it's a nothing, and so I would like to carry on my reasonably good health in 5 years' time. Because there's an Italian toast, I think. Of course, friends and family is the most important thing in life. But apart from that, there's time, health, and wealth. When you're young, you have time and health. And when you're working, you have wealth and health. And when you're retired, generally you have time and wealth, but no health. So, my aspiration has always been in order to enjoy my friends and family to the maximum, to have time, health, and wealth all at the same time for as long as possible.
Very good. So speaking of time, tell us a little bit about what takes up your time these days. You traveling all over Asia?
Well, COVID lockdowns. I guess I travel a lot with work, so I don't really have the travel bug anymore. I'm 20 years in Singapore. Prior to that, 10 years as an adult in Hong Kong. So been there, done that. So now, I'm happy family man, daddy. Morning I do my work and get some exercise. Afternoons, lunch, then home with the wife or friends, and I generally have a snooze after lunch to stay productive. Spend time with my daughter in the afternoons, and then evenings with friends and family again. Very happy with that.
Okay, let's have a little look at your bio now and your pinned post. I've got your profile open here, Lojikfool. That's spelled Lojikfool. Mik, do you want to read your bio for us, please?
Sure thing. Stock investing, more than 30 years, maths and psychology degree from London University, CISI Level 4 certification, advanced wealth management, 2 years performance plus 62%, 5 years performance plus 170%, which is a 22% CAGR. Long-term tech stock gains, no leverage, copy open trades, minimum 500, minimum 2 years. Start small, add funds over time to dollar cost average. Then there's a bunch of links, my Bloomberg feature on the front page, my Motley Fool, 99% high score, my investor education video. And then in 2018, I had my track record analyzed by KPMG, which gave 5 and 15-year annualized returns at 24% and 17%. Strategy: we are halfway through the 50-year migration to a fully mature digital economy. I invest in internet software, SaaS, cloud space, key investment pillars, disruptive, scalable, network effects, growing demographics or geographics, user-generated product, big dog and or first mover, quality leaders, maybe skin in the game, B2C or distributed user base, customer facing. And that's it.
So your KPMG certified results go back 17 years, you say, or 18 years?
Yes, somewhere in 03, I think it starts off.
And what's the difference between a long track record like that and a long track record on eToro?
I think not much, to be honest with you. A track record is a track record. I suppose, my pre-eToro track record, I didn't know it was going to be analyzed and made public, but I don't really see much difference there.
Okay, so tell us how all these years of investing and riding out tough times have equipped you to better perform these days.
Sure. Well, this is the theory of evolution, where I made every mistake in the book, maybe invented a few new ones, and the process of evolution over the last 20 years has literally been keep doing what works and stop doing what doesn't work. And to a greater extent now, I've stopped making a lot of the mistakes I used to make. We're never going to stop making mistakes, and I've evolved to where I am now, which is where I believe is the optimal portfolio mechanics and stock selection for fantastic long-term results, hand in hand with dollar cost averaging. The key is understanding that volatility isn't risk. Would you rather invest in a portfolio that has a performance of 10% and a volatility of 5%, or would you rather invest in a portfolio that has a return of 20% and a volatility of 30%? By every measure and metric, in the wealth management industry, the 10% for 5% volatility looks fantastic. But if you have, and that would be the right fund if you have a 1 or 2 or year time frame. But if you've got a longer time frame, as long as you're getting the return and you've got time to sit out the drops, and you're also dollar cost averaging into the drops, then the bigger volatility you go for, the better, which is really counterintuitive for a lot of people. I firmly believe that a lot of people get that backwards.
Okay, so with your track record and performance stats, here's a potentially tough question. Why don't you have 10,000 copiers?
Oh, I think recency is critically important. And look, I've done okay over the last couple of years on eToro, but I haven't done fantastically. And the reality is the pandemic threw me, and instead of sticking with the long term plan of buy and hold, I decided to take out insurance in the form of cash hedges, short hedges, against the risk of catastrophic losses. So, in hindsight, a mistake. At the time, it just felt like sensible insurance. And I did what I did, and the results are the results, and I'm completely fine where I've arrived at. I have made a change now. I have basically decided to run my eToro portfolio like an investment fund, whereby I will remain 90 to 100% invested and leave my copiers to decide how much they want to invest or hedge with their own cash savings. So the money they want to invest, I'll invest it for them. Also bearing in mind that most people's biggest cash hoard is just money they haven't earned yet. And that brings in the dollar cost averaging. And again, if most of my followers, my copiers, they're young, they've got long earnings runway ahead of them, they've got decades of investing runway ahead of them, then they should be 90 to 100% invested in high volatility, aggressive tech stocks. So I'm investing for them. At me now, with no income, 50 years old, with a family, I shouldn't be 90 to 100% invested. So I'm investing for my copiers more than myself.
Right. What I was sort of trying to get at there was a little bit more the copier mindset and the kind of people they're chasing, and maybe you're under-recognized. Your performance over the years is under-recognized, or maybe copiers they're all chasing the big money, or the young guys, the guys who are into Bitcoin, all that kind of stuff.
There is a tendency to like to have all green, which in general, I would say if a portfolio is all green, whether, either they're taking not enough risk or too much risk, in general, there may be exceptions, for many, many months or many years. I think you're right. I think a lot of the guys on eToro and gals are skew younger. They maybe haven't figured out how to differentiate between, play money, entertainment money, speculation money, and really putting your money to work for you for decades to make life-changing money. So I suppose back to recency, I've frankly, I've underperformed my tech peers for the last 2 years. I'll put my hand up to that. And, look, I've only been on the platform for just over 2 years. I'm as surprised as anyone. I wasn't aiming for PI or elite or anything. And it's funny, a lot of the PIs and elites I talked to, they weren't really targeting it. They just did what they did best, and it sort of happened. So that, I guess, that happened to me, even though I wasn't sticking to my long-term strategy. And so now I've decided to stick to my long-term strategy, and I would imagine, whether it's 1 year or 2 years or 5 years, I think my strategy will show its true long-term strength, and I'm just happy to watch it all play out.
Yeah, speaking of copier numbers, your trajectory, when I look at it here, was very steep. At one stage, it looked like Mik Mullins is going to the moon. And then there was a sudden peak and then a dropping off.
Yes.
Is that the pandemic you were talking about?
That's right. There was a period, October, November last year, and I had everything going for me. I had the results, I had editor's choice, I had another Bloomberg article, I had a eToro interview style article, I had the NASDAQ 100 pin post. I just had everything. And then second week of November, the vaccine results came in at instead of the expected 40 to 60% efficacy, they came in at 95% efficacy, and my hedged portfolio took a hammering.
Mm-hmm.
And with the result of a lot of people not liking the sudden drop in performance. Yeah. I was very careful to communicate everything all through. So I like to think, people knew what they were signing up for. But the simple fact is the vaccines blew away, everyone's expectations, which is fantastic, but not for my portfolio. And again, then I through November, December, I then communicated that I was gonna stick to my long-term strategy of mostly buy and hold, and not do. Look, the threat of the pandemic was receding with the vaccines, so I felt, look, it's now safe to go back to the long-term strategy. So, look, I paid my insurance. It was expensive insurance, but if the vaccines had come in at the expected 50% efficacy, then I could still be the golden boy.
Mm-hmm.
So I was happy to pay that insurance, basically.
Yeah. Well, eToro consider you something of a golden boy, don't they? I saw you recently on that four-way conversation. They had 4 PIs. There was you, Olivier Danville, Heloise Grief, and Mariano Pardo. So that's pretty exalted company.
That's right. I was indeed highly honored and privileged to be included in the group. And I think the guys at eToro, they've seen my long-term numbers, and because my long-term strategy within the industry is generally considered pretty optimal, I think they like to educate more eToro members to my way of thinking. If not copy me directly, but at least have an evolving mentality of less speculation, less short term, more long term, more buy and hold.
Yes, they're happy for eToro to be presented as a mature investment platform or a platform for mature investing.
Absolutely. Absolutely.
Hey, hope you're enjoying today's show. I'm sure you've subscribed already. If you're a successful copy trader, happy to share what you've learned. There's no need to have a public profile. Please get in touch. Otherwise, listener, the bigger the club, the better for you. So tell people on eToro about this show. Ask your PIs to come on. That way you will get to know them better. We build this club together. Mick, you often mention your 8 pillars of investing. Would you like to run through those for us?
Sure. And these are really the features of a company that I use as a checklist, really. The company has to pass maybe the first 3 key ones and the majority overall for me to even consider them as an investment. And as I go through them, you'll very quickly see it's basically internet software companies. So here they are: disruptive, which is doing things in a whole new and different way. And then you have scalable, which is the ability to ramp up fast without massive extra costs. Network effects, where if you and I have a Zoom account, that's great. But if everyone we know has a Zoom account, it's exponentially better. Growing demographics and geographics, penetration of smartphones, penetration geographically, user or customer generated product or content like a Facebook or a Twitter. Being the big dog and or first mover, helps a company get established and stay established. Quality leadership, of course, always important, critical. And I've noticed, this is the last one I added, there's sort of a customer-facing software, really, which is B2C or has a distributed user base where there's basically a lot of people using the product. It seems to be part of the winning formula. So yeah, that's all 8. The first 3 would be critical, and the remaining 5 would be important.
Okay, and that characterizes all the businesses you seek to invest in.
Yes, but a company can meet all the pillars, and I still wouldn't invest, possibly for valuation reasons. It would go on a watch list, or possibly, I think of a Snapchat. Met most of the pillars, but there were other reasons why I never chose to invest in Snapchat.
So let's just have a quick look at what's in your portfolio if we can.
Yep.
Mercado Libre, DocuSign, Pinterest, Teladoc Health, Trade Desk, SEC Limited. Of course, they're behind Shopee in Asia.
That's right. Garena is the cash cow, and Shopee is the e-commerce, and they have a fintech developing as well.
You've also got Square, Amazon. Oh, I noticed you own Alibaba in Hong Kong. Did I see that?
You did.
Yes, 9988. Why in Hong Kong and not Baba?
No particular reason. I know that there's been some requirements that the US listed ADRs need to be properly audited and in order to keep their listing. I think that's saber rattling. I don't think there's any real risk with the Chinese ADRs. But I've been investing on the Hong Kong stock market as for even longer than the US stock market. So I don't see any real risk with the ADRs. But for me, it's almost irrelevant which market I buy but
It's not because of tax advantages or something.
I would pay less withholding tax on dividends, but very, very few of my holdings pay dividends.
I notice it hasn't stopped Charlie Munger from buying Baba.
No, absolutely, yeah. I would have no issues buying the ADRs at all.
So your 8 pillars, as you were running through them, I was thinking to myself, each one of them pretty much, it sounds like, apply to eToro. Now, I know you're not allowed to say anything because you're a PI, but Do you think eToro as a public company might score well on your 8 pillars?
Well, I really wanted to write a post, but I checked the eToro feed, and then they're not posting anything due to conflict of interest. And I cannot say much, but if you go through my 8 pillars, it's pretty hard to see one they don't meet, which just leaves you with a valuation question, which I cannot answer for you today.
Maybe we can stop the recording there. You can give me a few tips. Well, I've already bought some. I mean, it's hard to value at this time anyway, isn't it?
Well, it is, but part of my performance comes from these high growth companies being very, very difficult to make assumptions on how big and how long are those growth runways. And people generally have been underestimating the length and the size of the runways for these digital economy companies.
Back to your portfolio, 20 to 30 stocks. Your largest holding is around, well, just under 5%. It says 4.5 months holding time.
Yes, well, that's probably going to go up now that I'm going to the long-term buy and hold strategy. That is the winning formula.
Okay, no hedging techniques.
No more shorting. I'm going to stick to what has worked best for the last 20 years. So no shorts. I may go up to 10% cash. I may not.
And it's all stocks.
Yep, it's going to be digital economy stocks. Again, that's evolved to be the most optimal performance long term.
I listened to your YouTube video where you appeared to be discussing with a bunch of expats in Singapore over martinis the whole idea of investing. And during that, you said something that I'd never heard before, that you were not interested in dancing chickens or vomiting camels.
Wow, I need to watch that again myself. I don't remember the vomiting camels.
Well, that was the first I'd heard of it, was you saying it. It's like a term relevant to technical analysis on charts. There's 2 humps and then a downward neck of a camel.
Okay.
Which is vomiting, and it's the downward trajectory of a stock price.
Yes. That's right. Well, the dancing chickens one I use all the time. So I do not subscribe to the idea of technical analysis beyond a sort of a potential self-fulfilling prophecy on herd mentality. So I don't use charts at all. I do look at prices relative to where they have been, before. But the whole idea of technical chart analysis and dancing chickens comes from one of Skinner's experiments, a colleague of Pavlov's dogs. If you feed pigeons at random times, they will start associating a particular behavior of theirs with the feeding, even though it's random. And they will start repeating, lifting one leg or turning in a circle, believing they have found a pattern in the randomness. And so that's my Skinner's pigeons, which I can just call dancing chickens.
Podcast gold. Okay, so let's talk about March. March wasn't a good month for you.
No, indeed.
Talk us through that, and then we're now into April. Things are looking a lot rosier in April.
Sure.
But come the end of April, do you think you'll look back at March as just a little blip?
Well, very interesting you say that. One of the things I show people, I show the crash of the Great Recession 08-09, where I had a maximum drawdown of, for the year, it was 50% plus. And if you try and find that on a chart now, you're really struggling to find it. So most of the blips, even the crashes of history, disappear into the ski ramp of the future. So yeah, look, I was up 20% year to date at one stage, and then I was down 10% year to date another stage, and now I'm about level. It's just all noise. Digital economy stocks are going to be in and out of favor. The economy is going to go round and round and round, and I'm just going to stick to what has evolved to be the best performing optimal portfolio, which is a portfolio of 20 to 30 digital economy stocks.
It's very, very interesting to hear all these differing approaches.
Sure.
You say it's just noise, just a blip. I've seen another PI, at least one, completely sell out of all his positions because he's expecting Armageddon.
Sure, and pay your insurance. But just remember, your insurance is probably going to eat into your performance over time if you keep taking out insurance. If you have a multi-decade time horizon, you can afford, and your dollar cost averaging, you can afford to ride out the waves.
There's a ton of information on your bio and pin posts. Very information dense. There's lots of links. You can learn a lot about Mik Mullins, and I have in researching for this podcast. I wonder how accessible that all is to the casual eToro user, copy trader, who's flicking about between PIs. And I was thinking about this earlier. We started this conversation talking about you're the guy who invested when he was young. You were able to retire at 42. You're sitting back, enjoying the good life now. And that is the aim of so many people on eToro. Would it not be worth your while to record a video of you sitting by the pool with the Singapore sling saying, this is what I did, you can do it too. Live the dream like Mik Mullins is doing.
I certainly would love to see more people understanding, the optimal strategy and portfolio. I do feel my investor education video hits that spot, but you've seen it. I mean, to what extent? To what extent do you think it might hit that spot? Because I'm not sure it can be done in a 10-minute format.
Yeah, I don't mean a long, detailed one. I mean just to strike that note of saying, hello, I'm Mik Mullins. I started investing when I was 19. I dollar cost averaged in working regular jobs, and I retired at 42 using my investing technique. That investing technique is now at work on eToro. So you want to join me? You want to retire by 42 and live in the tropics? Welcome to my bio and my pin post. Cheers. Clink.
That makes sense. That makes sense. I don't like to be. I may be arrogant, but I try not to appear arrogant. So I'd be more humble about it. But
okay. But self-publicity on a platform like eToro is an important thing. You have to stand out. You have to grab people's attention. Otherwise, they're flicking through thousands of profiles. And
sure.
Who's this guy with white hair? What can he do for me?
Sure.
Well, that's the answer.
You touch on something I've been thinking about as well a little bit. Really, is the feed disappears, off the radar very quickly. I do feel there should almost be a curated section where, not so much self-promotion of PIs, but there's a lot of really good articles from many PIs and everyone. And that it'd be great if there was a section where you could click in and see, okay, here's some really good articles on how to invest, why to invest, what to invest. Here's your crypto section. Here's your stocks section. Here's your tech section. Here's your currency section. And then it'd be there for posterity.
Yeah.
I don't write that many articles, but I try and make them count. I'll spend days, researching and writing an article, and sure, they've been great at pinning me to the NASDAQ 100 post for a few days, and then it's lost into the oblivion. They did ask me to do a similar recording to what you just described, and I'm not sure for what purpose that is to be used yet, but I imagine there are these guys, the world is their oyster. This stuff I'm sure will all be coming in due course. It just makes sense. It just makes sense.
How do you feel about your risk score? I've heard you describing yourself as a high risk investor. Are you comfortable with your risk score as it is? What is your risk score?
It's been hanging around 6.
6-ish, yeah.
Yeah, five for quite a while, and then 6. Well, what does risk mean, right? I mean, risk is not volatility, So I need to make sure I don't go above 6 in order to remain in the popular investor program. Fortunately, my optimal portfolio doesn't take me above 6, except like last March it went to 7 because of, obviously, with a crash, more volatility. Everyone's risk score is going to go up. So we'll cross that bridge if it happens again. And actually, eToro said if you're only stocks and not leveraged, you're allowed to have a risk score of 7. So I feel safe in that scenario.
What elements of your portfolio make your risk score what it is? I did an episode recently on the risk score in eToro. I imagine it's because the stocks you have are considered volatile, standard deviation.
Indeed.
And also there's less asset diversification, I guess, than they would like to see.
Yeah. Most of my holdings would correlate, and there wouldn't be anything with an inverse correlation to smooth it out. So, and some holdings are more volatile, more risky, than others. Look, as long as my risk score doesn't impact my stock selection choices, then I'm perfectly happy to operate completely independently of the risk score. As I mentioned earlier, if you have a multi-decade time horizon, any dollar cost averaging, you're probably looking for as higher risk, higher volatility, therefore higher labeled risk score as you possibly can, with the caveat that as long as you get the reward and not just the risk.
Yeah, there are plenty of eToro users with a very high risk tolerance. No doubt about that.
Indeed. But I think it's sensible they put a cap on at 6 or 7 for a non-leveraged equity portfolio. It smells about right. That there is a point at which portfolios could get too risky. There's a line which probably shouldn't be crossed somewhere. I have a few blue, tech blue chips. Your Apple, your Amazon, your Google, and they're there. I guess they're not just there as ballast. I believe in their long-term growth, but you need some workhorses. You don't want to be just racehorses, I guess. So within the digital economy space, having a blend of risks, of volatilities, I think has been optimal.
And you recommend that you are one PI in a portfolio of PIs?
Oh, good question. I worry about over diversification. Of course, I can't expect to be people's only pick. But maybe people should have if they have a short-term view, they can have some short-term PIs. If they have a medium-term view, they can have a medium-term PI and a long-term view. But I'm sitting here saying an optimal portfolio should not hold more than 30 stocks. Then you're going to get very, very quickly way over that by copying. Some PIs have way more than that. The problem with what's the opposite of having too many eggs in one basket? The problem with being over diversified is if your top performers, the performance is not going to have as big an impact on your total performance as you'd like it to.
Yeah, spread too thin.
And that's a again, if I'm defining a 20 to 30 as optimal, the more you stray from optimal, the lower your long-term performance is going to be. So maybe I would say try and keep it to a minimum. I'm not sure I think holding 10 PIs is optimal behavior.
Yeah, I have 4 currently. 2 stocks guys, 1 kind of commodities index guy, and 1 volatility guy.
Well, that starts to make sense, especially if you're hopping into other asset classes than just equity, and you have a more short term outlook portfolio in there as well. Yeah, something along those lines would make more sense than just holding 10 stock PIs.
You've spoken a little bit about the kind of people that should copy you and what their mentality should be in doing so. What sort of people shouldn't copy you?
Well, I think that a lot of people want to learn and experience investing, and you've got to do that by going out and making your own mistakes. And what I would say to them is take a little bit of money and go and do some short term stuff, and good luck to you. And hopefully you'll learn what you wanted to learn, and then start figuring out how to make the best money long term, which would be the optimal strategy.
I heard you before, I think it was during that investment video we mentioned, decrying money managers and mutual funds and the fees that you have to pay and how their performance is usually subpar anyway, and the fees you're paying eats into your ability to compound over years. And I've been down that road. And if somebody had have told me when I started that there was a guy who could give me 17% a year or thereabouts on a platform that costs almost nothing, I'd have bitten their hands off.
Sure. I mean, it's amazing what's going on in the industry, and I think the legacy funds, they've already needed to bring their fees down. But I think even now, actively managed, you can easily find an actively managed fund to go in for 2% a year, which over 20 years is becomes like half of your money is missing, even if it's gone up or not, kind of thing, right? So to have some of the best performing portfolios available for free, barring industry inexpensive spreads, particularly if you're going for someone with a reasonably low portfolio turnover, not leveraging, not shorting, the costs are negligible. And so if you're paying nothing and haven't getting good returns, then it back to that win-win-win situation. And people say, oh, well, where's eToro making all its money? Well, they sell the flow and they do make a little bit of money from the spreads, and they have to be competitive with other platforms and offer the leveraging and the shorting and the cryptos and what have you. So they make their money there.
So does that mean these traditional money managers are toast?
I think things could look very different in 20 years' time. I really do. It'd be nice to think that we're on the cutting, bleeding edge of a revolution here. I certainly think we're going to give them a run for their money and a wake up call. As you say, why pay 2% for something that underperforms benchmarks when you can pay nothing potentially, for something that might outperform the benchmarks? It's a no-brainer, as you say.
So my next question was going to be, do you think copy trading is here to stay? But I guess you've just answered that.
I think we've answered that one.
Okay, so Mik, you're a man of considerable experience. You've seen him come and go. What advice can you give me for Copy Traders Club? What should I be focusing on?
Oh, in terms of what?
In terms of content and providing value for copy traders, and who else should I be speaking to? What other questions should I be asking them?
Well, I think it's fantastic to get the live format. It gives eToro members a much better feel. I've been writing a lot of text, so I'm looking forward to putting this up on my feed and letting my copiers hear me. For content, I guess find the PIs and the copy traders with the best long-term performance and ask them what is their secret to their success. Because I recognize that, what I've defined as optimal for me, I'm living in my bubble. There may be other strategies out there that can also generate great returns long term.
Absolutely. There's more than one way to eat an orange.
That's right. So I'm biased, I wouldn't invest in other asset classes or for different time frames, but I happily accept that I don't have all the answers. I have my answers for me and what works for me.
Well, that's interesting because I feel the same about copy trading. I've come to eToro a different way from others, perhaps, and I've got my 4 guys, and I think that seems like a sensible approach, but I'm open to hearing from others who know better and have been around for a while and can maybe teach me a thing or two.
Sure.
I've no idea whether I've stumbled upon a winning formula because it's not time tested. I mean, it seems to make sense from the point of view of the books that I've read and, having an idea of balance of the portfolio, etc.
Sure.
But as we say, there are many approaches that could lead to nirvana.
Indeed. So I think get as many different winning formulas on as you can. And I wonder if you'll see a common theme emerge from that, and maybe we can all learn something.
Well, that would be the ideal. To see common threads and to get the opinions of people like you about what sort of copy trader you would be, that to me is a very interesting question to ask PIs. What would you do if you were a copy trader? Because they're applying all the years of wisdom and knowledge of the market, etc., and diversification to that same question that faces us all.
Yes. Indeed. I would probably find one copy trader whose strategy most closely matched mine, and I had some assurance. You want to see a few years of track record to get that credibility. Yeah, but that's an interesting one because it's very easy for my friends to copy me and only me on eToro. But I can absolutely understand why people who don't know me personally, the level of trust just doesn't exist.
Hence the need for a video.
Indeed. I hear you. I hear you.
All right, Mick. Well, look, it's been great to talk to you. I'm delighted to have you on for so many reasons, not just because you're the first whose year of birth was before mine. That was an important factor. We're playing with the cool kids here.
Brilliant, Gav. Thanks so much. It's been a real pleasure.
Very interesting to hear the thoughts of someone who has so many years of experience and feels he has ironed out many mistakes so his copiers won't be impacted by them. Worth considering as we copy younger, less experienced PIs. I would like to tell you who's on the next episode, but through inadequate forward planning, I can only say it could be one of 3 people. One is a PI, one is a copy trader, and one is from eToro. In any case, it is bound to be filled to the brim with nuggets of interest. Thanks for listening. Until next time we meet at Copy Traders Club, I wish you many happy returns. Obviously, anything you hear in this podcast is for entertainment only, not financial advice. Do your own research. This is just generic chit-chat. We don't know your individual circumstances, etc.